Hello, everyone, and welcome to a brand new endeavor out of the Barry Flinchbaugh Center for Ag and Food Policy. This is a new center and it is a new effort, and we want to tell you about what you'll be listening to over the next few moments, an in-depth look at the economic indicators at work currently. Before we do that, the Flinchbaugh Center want to tell you a bit about it. It was established in 2023, and the far-flung aim of the center is to improve understanding of policy alternatives and consequences of those alternatives, enable informed decisions of policymakers, of agricultural leaders, and food systems stakeholders, as well as the public at large, and to ensure that agricultural policies and strategies are based on facts and rational consideration. All of that in the spirit of the teachings of the center's namesake, Dr. Barry Flinchbaugh. And the center has chosen to look at a number of different and pertinent issues affecting agriculture: water, labor, sustainability, biosecurity, trade, profitability, biofuels, energy policy, soil health and conservation, climate smart policy, food insecurity, succession, and new farmer incentives. It's a broad brush that the center has undertaken in its initiatives. And so we want you to check out the website, and we'll remind you of the website as we go along here, to look at the treasure trove of information and the discussions of the initiatives that the center has taken on. That web address is flinchbaughcenter.com. That's all one word, flinchbaughcenter.com. Do have a look at that. If not right away, then after this program has completed. And we want to talk a bit about the center's namesake, and it's a name that rings familiar with so many of you out there. Longtime and revered agricultural policy specialist out of Kansas State University, Dr. Barry Flinchbaugh, universally known as the premier source of U.S. ag policy expertise, was Barry. He was a renowned teacher, 50 years in the classroom at Kansas State University. He was a vaunted speaker, very much in demand on the circuit, and he was a consultant to countless policy makers. In his spirit, we present these bits of information today, as well as the center's overall effort. FlinchbaughCenter.com is that site. One of the center's undertakings is this brand new podcast series. This is a quarterly review of the leading U.S. economic indicators and how they're trending, what they portend for the near and long term of the U.S. economy, and narrowing that down even more, the agricultural economy. And we have a panel of folks here who are well versed in this whole area. We want to introduce them to you now. Before I do that, though, I need to explain a little bit about the nature of the beast here. Thumbs up or thumbs down on the economy. That is our title. You may wonder, what does that mean? Well, that's the metric we're using to get a handle on what these economic indicators are telling us. If they are favorable, thumbs up. If they're not so favorable, thumbs down, as our analysts here will decide and share with us as we go along here. Our panel is the following: Dr. Mark Edelman, Professor Emeritus and longtime agricultural policy specialist at Iowa State University; Dr. Jennifer Ift. Jennifer is the Professor and Extension Specialist and the Flinchbaugh Agricultural Policy Chair at Kansas State University; and Dr. Brad Lubin, Agriculture Extension Professor and Agriculture and Public Policy Specialist at the University of Nebraska, Lincoln. Welcome to all of you, and thanks for participating in this. And before we get into our subjects today, we do want to ask each of you to just share a few thoughts and make a few comments about your relationship with the work and the teachings of Dr. Flinchbaugh. And Mark, you probably have the longest history of all here with Barry, so let you go first.
Well, I first took Dr. Flinchbaugh's course way back in 1974 and got so interested in what he said and how he said it that I asked him for a job after the semester was over and the grades were, and I got a good enough grade that I guess he decided to go ahead and hire me. But I drove him to extension meetings and became a grad student under him on use value appraisal. And then, with his influence, I ended up going to Purdue for a doctorate and became a policy specialist, first at South Dakota State and then at Iowa State in 1986. Way back in 1987, he and I actually did the first thumbs up, thumbs down on the economy for the American Bankers Association conference in Des Moines. And we did about 30 or 40 of those for ag banking conferences and farm conferences, farm organization conferences the following 2 decades, and ended up writing columns together during the last 20 years or so. He was a mentor, and he's the primary reason why I ended up doing what I've enjoyed doing for my professional career.
Jenny, you are the Flinchbaugh Agricultural Policy Chair at K-State. As was mentioned, your thoughts here.
So as the Flinchbaugh Agricultural Policy Chair, I frequently get told that I have big shoes to fill. And I've come to learn that that's true. Unfortunately, Barry left us too soon. I was only able to meet him once. But one of the many things I appreciate about Barry was how he built community. And that community has come together with the Flinchbaugh Center. And I would also say, in my position as the chair, it has made my work so much more impactful. There's a group of people from producers to crop insurance, agents to policymakers that will answer my calls or push me to push out certain information that makes my work so much more impactful. So I've been really thankful for that. Eric, I think you were one of the first ones. You said come and talk about crop insurance on the radio, and I wasn't sure about that, but now I do it all the time. So I really appreciate the community that Barry built and the community that's come together to honor him.
Brad, like Mark, you were a student of Barry's, to an extent anyway. Talk about your experience.
Well, that's right, Eric. I had the privilege, I think, of being one of Barry's last graduate students. Mark may have been the first, I may have been the last. An opportunity to learn from a mentor, never technically in the classroom, but all of the informal education and advising that happened in a collegial way was extremely valuable when I was on staff with K-State Research and Extension. And in the now 20 years I've been up at the University of Nebraska, it's that grounding that has sort of got me into policy in the first place and has elevated or sort of continued to motivate my work in this area.
Well stated to all of you, and right on to our 10 leading and key economic indicators that we want to analyze here in some depth. Several of these on the macro economy and some of these specific to the agriculture economy. The first one is the percent change in U.S. real gross domestic product. And folks can see on the screen here the chart that we're referring to. Brad, we'd like you to launch this and talk about the GDP trend, and the other two then will chime in with their thoughts as inclined.
Well, one thing we notice about U.S. GDP growth over time is it has been remarkably steady in the neighborhood of 2 to 3+% year in and year out. Steady growth, general growth in the overall U.S. economy, save for a couple major blips. One of those blips happened in 2008 and 2009 with what's known as the Great Recession. And another one of those blips was an extremely sharp downturn at the beginning of COVID. In 2020, at the beginning of the COVID pandemic, followed by an extremely sharp correction up immediately thereafter. So the U.S. economy has managed along in spite of some challenges and stresses. The real concern at the moment is that the trend is down. The trend is down and pointing down towards effectively no growth in the 2025 period, based on perceptions and expectations of economic challenges ahead of us.
Considered a thumbs down then?
If I'm voting on the economy, there are too many headwinds to be very, very excited right now. So yes, it's a thumbs down if we're concerned about the direction of the U.S. economy at present time.
Yeah, I'll go thumbs down too, in part because I think part of the slowdown has been the uncertainty that's been in the public discussion about tariffs and the approach that's been used the last few months to basically shock treatment our allies and other traders around the global trading picture. So people and businesses are sitting back, sorting out what to do in terms of making investments and making large purchases. So that uncertainty has really affected our outlook.
Jenny?
Ditto.
So, two thumbs down on real GDP, where it's going and what it's suggesting about the near-term future of our economy. The next chart we'd bring up would be the unemployment rate. And Mark, your thoughts?
Unemployment. Well, you can see the two spikes kind of mirror what Brad said in 2008, following the Great Recession. We had 10% unemployment, and then it took several years, basically 10 years, to whittle that unemployment rate back down to about 2%, 2 to 4%. But then when COVID hit, we spiked up at 15% unemployment. Well, that wasn't the highest we've ever seen. Back in the Great Depression 100 years ago, we reached 25% unemployment, but certainly 15% unemployment that's when we shut down the economy, essentially. But we recovered fairly well with the extra payments to keep everyone afloat, and our employment recovered, and our unemployment rates also recovered. We've ticked up just a little bit to about 4.2%. This past quarter, but the other employment number, 177,000 jobs, is a pretty robust new jobs growth number that kind of correlates with this unemployment rate that actually has generated some positive signs. So I would go thumbs up, at least for the short run, on unemployment and the new jobs creation.
Jenny, would you like to weigh in?
Yeah, I'm gonna have to say thumbs up as well. So two of the most important macroeconomic indicators that we look at are the labor market, unemployment, as well as inflation. And this is an area of real strength of the economy. So definitely thumbs up. I would also note there probably are some municipalities and cities where the decline in federal employment is having an impact, but overall federal employees are a very small share of the total workforce. So we're not seeing that here.
Brad?
Agreed on the sentiment. Nothing to add.
So, two indicators so far, one definitely to the downside, one more to the positive side. The third indicator we'd review here, Producer and Consumer Price Index. Jenny, you want to start the ball rolling on this?
Absolutely. So these are indicators of inflation, and we're looking at two different measures. One is the Consumer Price Index, that's in purple. That's been trending upward over time. The second one is the Producer Price Index. Specifically, you could think of this as for the whole ag and food value chain. So from farm products to processed foods and feed. That's trending upward as well, but it is more variable. So there is sort of, historically, if you look at pre-COVID, inflation was very stable. We expect some small level of increase, and this was considered within safe levels. Then a couple years after COVID, there was a period of more rapid inflation. And a lot of, people felt that at the grocery store and elsewhere. It has started to come down. You can also look at the Producer Price Index. Again, it's more variable, but, and we did see this post-COVID go up quite a bit. I think a lot of farmers and ranchers felt this in their input costs, and that did eventually go down. Producers are seeing some relief. Has started to increase in recent years as well. But I would say for both of these, it'd be a tentative thumbs up. That consumer price inflation has slowed. The Producer Price Index has also slowed. But it is something I'll definitely be watching over the next year that could potentially be impacted by tariffs or a trade war.
Mark or Brad, do you concur or refute that?
Yeah, I would concur that the only maybe cloudiness on the horizon that I see is maybe some of the dislocations that may occur as we readjust the trading patterns around the world that may cause some price rises in some areas. But generally, I would say that the inflation is at a good level at the current time, and I think the Fed's going to work hard to keep inflation under control.
And I would add to that thought and in an agreement. We have concerns, we have uncertainty relative to trade patterns and what that means for consumer purchases of global products. We have concerns about federal policy, Federal Reserve policy and the money supply. But look back just a few years, this is an overall price index. And so it looks like a gradual trend upward, which is consistent with fairly stable inflation rates. And then from 2020 through about 2022, you see that trend is steeper. And that was a period of much higher inflation, sort of post-COVID inflation, and some debate about whether it was transitory. Was that just an adjustment phase, or was it a little more long-lasting? Well, we've perhaps returned to the more stable inflation levels of 2 to 3%, but we're on a higher plane than we were pre-COVID. And so some of that post-COVID inflation seems to have stuck around. And that's one of the challenges that we probably have to absorb into the economy, and one of the challenges we'll have to work with. I think the current inflation rates are much more under control, but we're living with some of the inflationary challenges that we've seen over the past few years.
So cautionary thumbs up, it sounds, as far as this particular indicator is concerned.
We all three agreed in this case. So, I'm going to throw in a little color commentary because Barry was known for his color, and he always used to say that if you had two economists, you'd get a minimum of three opinions. Well, we're trying the reverse of that, where we've got three economists and we're struggling to get two opinions. So anyway, we've all agreed on everything so far.
We're witnessing a rarity here. It's a marvelous thing. Our next indicator, the effective federal funds rate. That would, of course, translate into interest rate considerations here. Brad, your thoughts on this chart?
Well, if you look at the majority of the last 20 years, we have been in historically low interest rate environments with relatively stable inflation. There has not been as much pressure on the Federal Reserve to try and tighten up money and to try and slow down the economy. And we've had, in fact, almost pushes to the zero bound at the lower limit of how far down we can go with interest rates to help spur on the economy. So some of the challenge here is that we didn't have much of a signal from the Fed funds rate for several years in terms of direction. Now, we had a sharp increase in federal funds interest rates here, Fed funds rates from basically 2022 onward, as the Fed was fighting that inflationary pressure that we just talked about. They have eased back a bit on the Fed funds rate since, but we still have, by recent standards, much higher interest rates to work with today. By historical standards, if this was a 50-year chart, these would still look small. But by recent standards, we have a much higher interest rate to work with today than we've had.
That earning a thumbs down from you, Brad?
I think it's more along stable, probably a cautionary thumbs up in the sense of we're into a little more stable interest rate environment. But the cautionary part is we also have to adjust to what seems to be a much higher interest rate environment relative to where we've been over the past decade. And that means that capital comes at a more expensive cost to businesses that need capital.
Well, I'm going to go with thumbs up too. Maybe it's because I remember I had to pay a 17% mortgage rate back in the early 19. So you look at these charts, we're at a much lower plane than back in those olden days. So I'm going to go thumbs up too, even though notwithstanding your cautionary outlook.
And I would just add, with our current rates, the Fed does have some flexibility to raise or increase interest rates depending on what the macroeconomic conditions are. Just also want to bring in a little the dismal science or alternatives and consequences. Historically low interest rates were not without trade-offs. If you have low interest rates, it's nice if you're a borrower, but it can lead to higher asset and farmland prices.
Let's turn to our next indicator then. Government spending and surplus or deficit, depending on what the case may be. And we'll go with Mark on this one. And government spending has certainly been in the limelight in the recent months?
Yeah, we ought to. As we look at this chart, let's take a little bit to figure out what we got here. We've got spending on the upper line, and that went from about 4 trillion back in 2004 up to over 10 trillion in the latest number that's shown. And it kind of depends on whether you look at the federal budget with the trust funds in it or without. And certainly the problem has been that we have not been raising enough tax revenue to go along with spending. And as a result is the bottom line, which is the deficit. And you notice during the whole 20-year period there in the chart, the bottom line is below zero. So that's where our annual deficits come in, and we're trending down to about 2 trillion a year on deficit relative to 10 trillion in spending a year. So that means we're raising about 8 trillion. Part of the concern with this, though, too, is as we add to the deficits annually to the public debt, we're now up to 36 trillion in public debt, and we have to pay interest on that. Interest is not a discretionary area of spending, and it's approached 1 trillion in spending picture. And so I'm not confident that we're going to change the pattern very much over the next few years. So I'm going to go thumbs down on government spending. Of course, as it affects the farm economy, the farm spending is a small portion of the spending that's in this budget picture. So thumbs down for me on government deficits.
Jenny or Brad?
So I will also say thumbs down, mostly looking at the trend. Eventually, if you want to reverse this trend, you have to raise taxes or cut spending in one of the major categories, which would be defense, Social Security, Medicare, and Medicaid, none of which are politically attracted. So my fear is that this isn't addressed until we have a real crisis on our hands.
I have to add in here only to the sense of, if I can, it's 2 thumbs down, because there are very few positive signals in this data. If you take this data back 50 years, we basically have had a deficit, a structural deficit in the federal government budget since about 1970. There was a brief period in the late 1990s when we actually saw a surplus, and just as quickly we figured out how to spend it away. And so we've been running a deficit and been accumulating federal government debt since. You see blips there in 2009, again, the Great Recession, where the deficit got bigger. And we were extremely worried about the fact that the deficit was 10% of the GDP. And then that pales in comparison to what we saw in 2020 and 2021 with COVID era responses and economic stimulus and other policy decisions that ballooned a deficit to between 10 and 15% of GDP. Those are numbers that haven't been matched unless you go far enough back to World War II. So these are historic levels of government spending relative to revenues. And as Jenny described it, the situation ahead is, if there's any sense that we need to balance spending against revenues, then that means dealing with higher taxes, which aren't popular, or dealing with spending on the military or the social safety net, Social Security, Medicare, Medicaid, none of which are popular. You could strike virtually everything else in the federal government budget and still not solve this issue if you can't solve the big questions. And I have yet to see the government sort of demonstrate that it's ready to even ask those questions, let alone solve them.
Then 4 thumbs down from 3 economists. Back to what you said, Mark. It's noteworthy.
Yeah, we haven't found any debate yet. We'll have to work on that.
We'll keep digging. We'll get there. Our next indicator, the real broad effective exchange rate for the United States. And outline this a bit more for us, Jenny, if you would.
All right, so this is the exchange rate for the US dollar. So it looks at sort of across all countries, what can you exchange US dollar for other currencies? It also takes into account the relative price of goods across countries. And so we go back, like with the other charts, we go back 20 years to 2006. And broadly, it's been pretty stable. You see a slight downward trend at the beginning part of our period. It's sort of flat from 2010 to 14. And the dollar has been strengthening since then. So it's been a gradual upward trend that currently doesn't doesn't show a sign of stopping at a slight downward movement in the last quarter, but the dollar is getting stronger, which generally means it's more affordable for us to import, but the cost of the goods that we produce are more expensive abroad. So there's definitely some real trade-offs there.
So how do any of you read this trend and what it's suggesting?
I'd have to come in on a thumbs down here if I'm thinking about the strength of the U.S. dollar over the long run going ahead. The fact that we've had a continually strengthening dollar over most of the last 20 years, it's partly a function of, in spite of whatever warts and challenges the U.S. economy has had, it has generally outperformed the rest of the world over the last 2 decades. And that dollar has strengthened over time accordingly. The question at the moment for me is, with all of the trade uncertainty, to this point, the US dollar has still been the currency of choice, and it's the reserve currency of the world, and it's the basic denomination that we use for measuring global trade. If U.S. trade policy is constraining or challenging some of the partnerships and flows that we have, then the role of the U.S. dollar gets a little more uncertain, and the strength of the dollar maybe faces more challenges going forward.
Yeah, I would agree with thumbs down on this too. Somewhat related to the last chart as well. You know, a majority of our debt is held in foreign hands, and that's part of what Brad was explaining there as well. That, and you think about it, if the rest of the world is our banker for our federal debt, then that puts a different light on some of the negotiations about trade. If all of a sudden China or other nations decide to dump U.S. dollars onto the market, that would make our Federal Reserve a little bit nervous and would have to respond as well in order to keep our exchange somewhat stable, or the value of the dollar stable. But as the value of the dollar goes up, we can buy imports more inexpensively, and our exports become more expensive to customers around the world, and that's one of the basic trends that's affected our ag trade.
2 thumbs down there, segueing nicely into our next chart that we'd like to bring up. And this moves away from the macro and a little more into the specific agricultural economy spectrum, the total value of U.S. agricultural trade. And Brad, set the table here on this, if you would.
Well, first off, to see our chart over the last 20 years, we have generally seen growth in exports and growth in imports. Yes, we're a major agricultural producer in the world, and we're a major exporter of those ag products. We also are the number one consumer market in the world, and we're a major importer of many ag products as well. Often, maybe most of the time, those are complementary products. We export grains, and we export meat, and we import coffee and other exotic fruits and so forth. Sometimes they appear to be competing products. We actually export beef and import beef at the same time. Well, but it is different. We export higher value cuts. We tend to import lean trim that complements our ground beef production in the U.S. So those are some of the mechanics behind trade and trade patterns. But what we have seen here is that exports have actually fallen back in the last couple of years. 23 and 24 have fallen back from the record of 22. Imports, however, have continued to push higher. And we actually have a rather sizable trade deficit, even in agriculture, which is one of the sectors we historically always said was one of the few U.S. sectors that ran a trade surplus. Well, right now we're running a trade deficit. And some of the challenges we see with U.S. exports and trade policy don't really tell a better tale of this going forward. So it's a thumbs down at the moment until we see better signs of what's going on in the trade front.
I would agree with a very qualified thumbs down. I don't think having the trade deficit per se is a bad thing. Chocolate, coffee, tequila, and bananas generally improve our quality of life. So, what we're importing is less of a concern. What I worry about is that we're going to have trouble exporting the things that we're good at producing. And the fact that exports are stagnant after sort of a general upward trend for a long time is what really concerns me.
I would add to that, if we think about who are our top ag export markets, It's Canada, Mexico, China, and the European Union. And then you ask the question of who, as far as the trade negotiations, have we been poking in the eye to get them to try to strike a better trade? Well, it's that same group. Perhaps the new one on the front is we'd like to export more to India. It's a possibility. Japan has always been a good customer too, but I'm reminded of the story that Barry always used to tell about when he was on this was back 40 years ago in a different environment, but he was on a League of Women Voters panel to discuss the high price of meat with somebody that represented the beef industry at that time, and the cowboy got flustered about how much steak cost when they asked the question, and he said, "Steak is good for you, buy it and shut up." Barry then commented, "How many pounds of beef do you think you sold with that statement?" So, I mean, there's some real questions about if we make our potential allies really uncertain about our goals in trade negotiations publicly, will we be able to get them to come around to settle on a positive trade policy for us when the dust settles? That's a big question that we'll see if the president can pull a rabbit out of his hat.
A fair amount of uncertainty in any event on that one. And then we talk about the next chart, U.S. inflation-adjusted net farm income components, which of course would dovetail into what we just spoke about regarding agricultural trading trends. And Mark, talk about this one, if you would.
Yeah, well, we've got 4 lines across the 20-year chart there. The blue line is crop receipts. The yellow line is animal product receipts. The next one down is cash net farm income. And then the bottom one is government direct payments. And so this is what we're using as an indicator of the health of the ag sector. And of course, the thing that we ought to point out is the last year is when direct government payments blipped up with the extra disaster aid that we passed at the end of last year. And of course, that made all the difference on net cash farm income for that last year as well, at least what the chart shows. I would also note too that without getting too political here, during the Trump 1 years, you had net cash farm income during the 17, 18, 19 period pretty low relative to 2022 and back 2012. But it looks like, at least for this next year, if the president can keep on track, that net cash farm income is on an upward trend. We'll see where that ends up at the end of this next year. But prior records were during the Biden and Obama years. So we'll see if we can top that or not during the coming 4-year period.
So do you describe that as a thumbs up, thumbs down, thumbs sideways? What?
Well, I'm gonna go slightly thumbs down because I think right now it's really the beef sector and that's not doing too bad, but most of the crops are headed south, and if we don't get some trade markets developed for us, that's going to continue to put pressure on keeping government payments high. And of course, the secretary said the president is going to do good for the farmers if the trade picture doesn't pan out like he thought it should.
What say you here, Jenny or Brad?
I'm gonna go with a real thumbs down here. I think if you look at both crop receipts and animal and products receipts, those are both going down. So your fundamentals are going down. This year, the government payments, that's about farm survival. That's not about things being good. And a lot of those payments go back, are ad hoc payments that were passed for either 2004 or 2003 losses for crop farms. Definitely happy for the beef producers. I know in Kansas' perspective is that they finally have a chance to make some money, but I think the overall picture isn't great.
If I can add in here, somehow I've got to do this because it's a thumbs up, thumbs down kind of ag economy right now. You can see it in the crop receipts and the livestock receipts. Crop receipts have been trending down for 3 years from the records of 2022. Livestock receipts, at least nationally, are fairly stable, but they are much stronger, certainly, than the crop side. In fact, the thumbs up is because we're at near record farm income levels, at least projected for 2025. And in some states like mine, we are projecting a record. And it's really hard to reconcile how we have a projected record farm income at the same time that we have really declining and challenging farm sentiment out there. And I described it as, well, it's kind of like a tale of two farms, or maybe more specifically, a tale of a farm and a ranch, because the crop farm is certainly facing more challenges this year than it has, and it's faced increased challenges over the last 3 years. The livestock farm, the ranch, is benefiting from cattle. Record cattle prices and sustained demand have so far carried that sector pretty well. Neither of them have the long run rosy forecast maybe to be thumbs up, but at least at the moment, there's plenty of cash flow to make the sector as a whole look strong. Of course, yes, much of that cash flow is coming from government assistance, and we don't ever really sort of fall on that and count on that, but yet it's there and it's helped the ag economy here for the year.
Speaking of cash flow, that really leads us into our next chart, and that is farm debt to cash flow ratio. Jenny, what are we seeing here?
So this looks at how large farm debt is relative to net cash farm income. And it's not a typical measure that we use, but it's a nice way to get at farm liquidity. So what's the value of the debt we hold relative to how much income we have coming in to repay those debt obligations? And this does actually move up and down quite a bit. Farm debt has been trending upward for the entire period. So most of the fluctuations here reflect farm income. And if we look at recent years, you see this going down in 2025, which would indicate more liquidity. And this sort of increase in liquidity reflects those government payments that we're seeing in 2025. So 30 billion for losses incurred in 2023 and 2024. I think there's two ways to look at this. You know, if you kind of look, okay, we're right at about the average between 2.5 and 3. So from a historic level, this looks like it would be okay. One thing I do worry, this uses official farm debt forecast, concerned that it's not picking up vendor finance or non-bank finance that doesn't get formally reported and probably isn't fully incorporated in those the USDA debt forecast. So on the surface, it looks like a thumbs up, but I think that there's a lot of potential tailwinds with it. You know, debt levels might be higher than expected, and we have had farm debt trending upward for the entire time period.
And your thoughts, gentlemen, on this?
Yeah, I'm not exactly sure how to interpret this one. I'm kind of toying with the idea of doing what Brad did, thumbs up, thumbs down at the same time, something like that. But 77% of U.S. farms don't have any debt. So we're really talking about the 23% that do have farm debt. And of course, the interest on that debt is a farm expense that those 23% have that the other 77% don't have. And so I think there's a real risk in the current outlook particularly for those who hold debt, which tend to be younger farmers oftentimes, for financial stress to creep up on us in that case. And if land values would happen to turn down, then that would really make these liquidity picture look pretty bleak going forward. For the current moment, I think it's manageable, so I'll go a slightly thumbs up currently, recognizing that not everybody's in the same boat.
I would concur with the general discussion here that it's a focus as Jenny noted, it's maybe not the standard financial ratio that we might hear about in the Sweet 16 or the Sweet whatever the number is these days, but it's a number that points to liquidity. And we're definitely not in a solvency crisis in agriculture at the moment. We are concerned about liquidity with higher costs and dropping revenues and higher interest rates, meaning higher debt service needs. But for the moment, it's still quite a manageable statistic, it looks like.
Let's talk about those farmland values. That is our next and final chart, the U.S. inflation-adjusted farmland values. These on a dollar per acre basis here. And we've marveled at how farmland values have risen remarkably over the last decade or so. Where are we at now, and what do you think we're going to see in the future here, Brad?
Yeah, if you look at those numbers and you realize farmland values have effectively doubled in the last 20 years in real terms. It has been a prime investment opportunity, and some of the non-ag sector is recognizing that that's a great opportunity relative, or it has been a great opportunity relative to other markets. But if you also look at the picture ahead, you see concerns about profitability, you see concerns about cash flow, you see concerns about future market prospects, and you're wondering, how can we continue to drive these land values where we're at? Land values have gone up and they've continued to climb, perhaps as a result of the last few years of very strong profitability, maybe accumulated capital. And we still have farmers being the predominant, other farmers being the predominant buyer of farmland. We talk about outside investors, we talk about equity money getting into agriculture, and yet it's farmers bidding against farmers that are driving these farmland values higher. So it's still driven by fundamentals in the ag market to date. And there is question and expectation that it may level off here with current economic concerns in agriculture, but it's still a relatively strong, it's got a strong base, and it looks like it's a relatively strong market for the time being. So I'm still giving it a thumbs up, even if I'm less certain about the future direction here.
Mark, Jenny, what do you think? Again,
I'm gonna go with a slight thumbs down because I see farmland values softening this next year, in part because I don't think the net farm income is not going to be there as to justify a continued rise in farmland value that we've seen in recent past. So I'm going to go slight thumbs down.
so we have conflict finally. Jenny, break the tie.
Well, oh gosh. I was gonna do this. This is a strength for those who own land and are involved in farming. The strong balance sheet. It does help you weather rough economic times, and there's a lot of factors other than the farm economy that do prop up farm land values. I'd also say the softening might be the sign of a healthy farmland market. The farmland market should reflect the underlying economic fundamentals. It's as if we go beyond the softening that I worry about. Also, strong farmland values do create some challenges for young and beginning and small farms. And these are groups of farms that both the previous administrations and the current administrations, have talked about. The current administration just put out a document last week talking about how it's going to support small family farms. And, those high farmland values do make it harder for those farms to get into farming or to expand and remain competitive.
Well, we've gone through all of this information, and there are some modest positives that look like they're at work out there. There are some definite headwinds respective to other things here. So I would ask each of you to offer a summary comment on the economy broadly, the ag economy more narrowly, and your gut feeling about the lay of the land here as we move through the next half a year or so. Brad, start us off.
If I'm painting an economic picture, what's ahead for the next, let's say, 12 to 24 months or so, the ag economy faces more pressure as we worry about markets, as export market opportunities, as we worry about uncertainty in the policy arena. The general economy also faces pressure as we deal with the continued growth in the federal budget deficit, the continued growth in the accumulated federal debt, the direction for the general economy. So there are signals and concerns, and maybe more uncertainty than ever for the outlook. We are still building off of a very strong base, and so we're not necessarily falling into a great deep trough here. But the outlook ahead for the next few months is a little more challenging than it's been.
Yeah, for my summary, I guess I would say I have a great deal of confidence that the Federal Reserve, as long as it's allowed to remain independent in making its decisions, that it will successfully manage the general economy. My real concern is focused on the ag economy, and I think the ag economy, we need to get to work. We need to get to work on getting the trade deals done, and we need to get to work to allow biofuels the capacity to utilize domestically what we're producing. And I think that's basically who we're selling to is our food customers, our fuel customers, and our international trade customers. And right now, we aren't expanding the population very fast domestically. And so when you hear words that we need to sell more domestically, we're talking about, well, let's look at fuels. And we can produce some additional biofuels for sustainable aviation fuel going forward, and that would certainly help the sector out tremendously. And we need to get those rabbits pulled out of the hat on trade to get the trade markets up there.
All right, I'll start with the macro economy. I think overall we're coming from a place of strength and resilience, notwithstanding the long-term challenge with the federal spending and deficit. Definitely some short-term challenges as well with uncertainty around trade and GDP. On the farm sector side, there definitely is a lot of resilience, and the livestock sector is generally doing pretty well. That's cyclical. Crop farms have done well in the past, so livestock sector has seen more challenges. I do worry about where crop farms are, and I know the financial situation is a real mixed bag. There's more established producers or producers that have managed to build up some liquidity over the past years who are prepared to weather the storm. But I know in Kansas and other states, we've also seen some farms that have had financial difficulties in the last few years. I think, and I did look at 2025 forecast farm income. And even with the government payments, it looks like debt repayment is going to be an issue for a lot of corn, soybean, and wheat farm businesses. So, there are indicators of financial stress out there with liquidity. And again, it's a very mixed bag. But you combine that with the market and trade uncertainty, I think that there are definitely some real headwinds out there. And, like Brad and Mark said, hopefully some of these trade deals materialize and we get to a more stable position.
Great input from you all, and thanks for breaking all of this down for us right here. We'd remind you that the podcast is archived on the website, and we are asking you, viewers and listeners, for feedback and to become familiar with all aspects of the center's evolving work as you consider the Barry Flinchbaugh Center in education, information, research, and scholarship. And we would invite you to consider supporting those efforts, flinchbaughcenter.com, to get that correct. And we do want to extend an invitation to you as a final thought today. The Barry Flinchbaugh Center for Ag and Food Policy invites you to step into the classroom of Dr. Barry Flinchbaugh. This is at the inaugural Flinchbaugh Forum. It is set for Friday, September the 26th, and the venue is the Bluemont Hotel in Manhattan, Kansas. That's just adjacent to the K-State campus. This is designed in the spirit of Dr. Flinchbaugh's lectures. It's a one-day event, and it'll bring together producers, policymakers, economists, and industry leaders for what we're billing as a bold and unfiltered conversation or two on the future of agriculture and economic policy. And then we'll close the day where Barry would have wanted it, a drink in hand, as we'll be toasting to his legacy to conclude that event. For updates on this event and for upcoming registration for it, please check out flinchbaughcenter.com and follow the center as well on Facebook or on LinkedIn. We'd love to see you in Manhattan in September. I'd like to thank the panelists once again for offering their thoughts. Brad Lubin of the University of Nebraska-Lincoln, Mark Edelman of Iowa State University, and Jenny Ift of Kansas State University. And the next podcast, as we're a quarterly effort, will be in August. Be watching for that coming your way in about 3 months. Until then, Eric Atkinson, thanking you for joining us.